Hello and welcome. Today we're working on Chapter 11, which is financial reporting, and it deals with corporations, all the features of a corporation and stockholders' equity. So if you're new, my name is Jeff from Finally Learn. Please like and comment and subscribe. We'd love to have you join the channel. Now, financial reporting is, we have a corporate approach in our accounting class. So we're talking about financial reporting. What does it mean to be a corporation and stockholders' equity? So let's talk about a corporation specifically here, where it's a separate legal entity. It has at least one owner. Some states you can file and be one owner, but then some states you have to have more than one owner, but generally more than one owner. You file what's called articles of incorporation with the state. So all the states have, the Secretary of State's office basically would let you file articles of incorporation. It's your birth certificate for your corporation. And so then you have to use the word corporation or incorporated, corp or inc. And then stock represents the ownership. You could sell stock to owners, or if it's just you and a partner, you would issue shares and then you would put money in as a stockholder. Now, what are the advantages of a stockholder? Well, advantages of a corporation really are limited liability. Why would you spend the money and the time and the effort to incorporate? Well, you have limited liability, so you can only lose the amount that's invested. Your personal assets are protected. If you could lose your personal assets, that's called unlimited liability, and that is not a good situation. The other thing that's nice about stockholders and corporation is there's an ease of transfer of ownership. All you have to do is transfer shares. So you transfer shares, and the new person that owns the shares now owns either a portion or the entire amount of the stock, which they own the corporation. So corporations are, all the big companies are generally corporations, so you have access to more capital. Now, big disadvantage on the corporate form is double taxation. Now, double taxation, a lot of times it's called double taxation on dividends. And so what happens is there is a corporate tax rate, the company pays tax, and then anytime they issue dividends to the stockholders, then the stockholders pay tax on the dividends that already represents taxed income. So therefore, double taxation on the dividends. If any dividends are issued, then they're taxed again, which is a second taxation. Now, there are four really forms of business. Sometimes you'll see it three, the first three: proprietorship, partnership, corporation. But there's really a fourth one now, LLC. So let's talk about what these are, just so you know what happens. Now, if you start to bake cookies, if you start to bake cookies and you make a little side business and you sell cookies at the holidays, well, you're really a proprietorship. It doesn't take anything to get started. You may not have a separate bank account, but it's one owner. There's no legal structure. Really simple. The problem is, if you want to make it a real business, then you want to make it more formal and better for you with limited liability and so on. So proprietorship is anytime you have a business, it's one owner, no legal structure. The big disadvantage is you have unlimited liability. Now, if you go in with a partner, two or more people would have a partnership. There's still no legal structure. You could have a partnership agreement. You should have a partnership agreement. But what you want to do is, I would recommend you should have a corporation or an LLC rather than the first two. If you're going to be really in business, then you need to do it the right way and be a corporation. There's pros and cons, or be an LLC. Corporation is what we've talked about. LLC stands for Limited Liability Company. So limited liability company looks a little bit like a corporation. You have to file, but then it looks a little bit like a partnership, and generally you're taxed like a partnership. Limited liability company, the big advantage is limited liability. That's why the name is Limited Liability Company. And it's taxed like a partnership. There's no double taxation. So these are advantages here. And so you should create a corporation or an LLC when you start a business. So therefore you need to get a tax ID number, an EIN, a bank account in the business name. So treat it like a separate entity because it is a separate entity. If you make it like your personal bank account, then it doesn't look like a separate entity. Now, let's go back to the corporation. The corporation structure is at the very top, all the stockholders, they elect a board of directors who hires management like a CEO, a CFO, the vice presidents, and then you have employees. So that's the corporate structure. Now, if you buy stock, then you have certain rights as a stockholder. You have a right to vote for the board of directors. You have the right to sell your stock. You have the preemptive right. Preemptive right says, look, if we issue more shares and I own 10%, I want to keep my proportional ownership, then I have the right, the first right before anybody else, to buy 10% of the new stock. So the preemptive right lets you keep your proportional holdings. You have a right to receive dividends. All the shares are equal. If you own 100 shares and somebody owns one, you get 100 times more, but you get the same amount per share. And at the very end, you have a right to receive assets in liquidation. So let's think about what some terms around the stock would be. So common stock, every company, every corporation has common stock, and it has a par value and it has the corporation name. So par value is just a legal term and it's used to record stock transaction. But as of now, in the modern world, it has no economic value. So par value, you could see on the share of stock, if you looked at a stock and it said, oh, it has $5 par value, you say, well, oh, this is 100 shares times 5, must be worth 500. No, it could be worth nothing. It could be a bankrupt company, or it could be worth $50 a share, and there'd be much, much more than the $5 par value. What we really care about is the market price, or the stock price, or the market value, not par value. Now, a couple of terms related to the stock is authorized number of shares, the issued number of shares, and outstanding number of shares. Now, with the corporate charter or the articles of incorporation, you would have an amount of shares that are authorized that the company can issue. So in this case, let's say it's $10 million. And then they actually sell some. So in this case, let's say it's $7 million. Well, generally what happens is you have authorized and issued, but sometimes a company would buy back its shares. So let's say they repurchased 1 million shares. So now it's still issued 7 million, but outstanding is only 6 million. The difference is treasury stock. Now, the one we really care about is outstanding. Outstanding shares get to vote, they get dividends, they represent ownership. So outstanding is the true number that we care about. Now, the treasury stock has been issued, but it's no longer held by the stockholders, so it's no longer outstanding. So in this case, this little corporation would pay dividends on the 6 million shares, and they would only have 6 million votes. One vote, one share, so on. Now let's talk about stockholders' equity. Stockholders' equity is made up of two sections. There's the paid-in capital, which is common stock or preferred stock, or an account we'll see just in a minute called APIC, or an additional paid-in capital. So this is what the owners put in, the paid-in capital. And then we have what we earn. We have our retained earnings. Retained earnings is the total of all previous net income or earnings less all previous dividends. So the way we calculate retained earnings, we start with, let's say we have $100,000 as our beginning retained earnings. And let's say our net income is $20,000 and our dividends are let's say $5,000. So what we have is we have beginning plus 20 minus the 5, and so we're going to have a total of $115,000 is our ending retained earnings. All right, now let's do a couple little problems here to show when we issue stock. So let's issue stock that has par value, and we're going to sell it for above par value. So let's say Auburn Corp issues 30,000 shares of $1 par common stock for $35 per share. All right, so how much have they received? Well, they're going to receive 30,000 shares times $35. So the total cash that they've received is $1,050,000. Now we're going to have to record the common stock at par value. I have a little note here. It's got to be at par value. So we're going to take the 30,000 shares times $1. Now, I don't know if I had to calculate times 1, but you see what happens. 30,000 times 1 is 30,000. It's not the number of shares, it's 30,000 times the $1. And then additional paid in capital is anything left. 1,050,000 minus the 30,000, and that's going to equal 1,020,000. So we call this APIC common stock. What is APIC? Additional paid in capital, or sometimes you hear it called paid in capital in excess of par value. That's a long title, so generally what I want to do, and what a lot of people do, is just do it called APIC, additional paid in capital. So that's the entry. What if you issue the common stock at par value? Baylor Corp issues 40,000 shares of $10 par common stock for $10 per share. Well, we're going to take the 40,000 times 10, and that's 400,000 is cash, and there's no par, so we just record everything in common stock, and we have debit cash and we credit common stock for 400,000. Now we could have stock that has no par value. So let's say Colgate Corp issues 50,000 shares of no par common stock for $18 per share. Well, we're going to take the 50,000 times $18. So there we have 900,000 we received, and we record it all in common stock for 900,000. If we have no par value stock, then we don't need the additional paid in capital or the APIC account. Now we have one more here. What if we buy land by issuing common stock? Delta Corp issues 55,000 shares of $1 par common stock to buy land with a fair value of $550,000. Now, since we know this, we know it's $550,000, then we use that. If we didn't know the value of the land, but we knew that we had a share price that was traded on the stock, we would use that. But here we're saying that we paid $550,000 for the land, and the common stock is going to be 55,000 times $1 par, and then our additional paid in capital is going to be the difference. So 550 minus 55 is going to equal 495,000. What if the par value of this company was really, instead of 1, let's make it $3 par. So it's just a small, maybe meaningless number. You know, it has no economic value. Well, what would we do? We would have to record the 55,000 shares times 3, and we record common stock as 165, and APIC, or additional paid in capital, is 385,000. Hey, if this is helpful, please like, please subscribe. YouTube has a video that they think you'll really, really like.